government bond auctions, how they work. So in this example, I'm going to say government is trying to sell 10 billion worth of a bond. What they will do is they will go out to the banks and solicit bids for this bond. The bids will come in the form of an amount for a certain yield. So you'll then get a big long line of bids. So you'll get a bid for a certain amount at various different yields along this line. Now, what the government does is, because they want to sell 10 billion, once they've got 10 billion worth of bids, they can say, right, we're going to have a cut-off here, and say this cut-off is 2.7%. Anyone who's bid below 2.7% gets their bonds. So all of these banks are now long, and all of these banks don't get anything because they've bid a yield that is too high for the government to be willing to sell at. So they can get all 10 billion away for anything under 2.7. So they all get their bonds. Now, what does this mean in terms of trading? Well, all of these banks are now long. So what they need to do is they need to hedge that risk. What will often happen is coming into the auction, so before the auction is actually priced, so before they actually know exactly what this number's going to be, they'll have a rough idea and they'll be thinking, right, I'm bidding 2.5, so I'm probably going to get the bonds that I want. What they do is, because they know they're going to be long, is they sell the futures in anticipation of being long, so that they have already pre-hedged the bonds that they're going to get. What happens, or where there is a trade, is there's two trades. There's a trade on the fact that they may not get them. If for some reason actually there's huge demand for these bonds and they price them at 2.3, what happens is everyone who's hedged their 2.5, thinking they're going to be long, all of a sudden is just short, and they're short the futures, so they have to buy them back up, and that's where you get a rally out. Also, you get the other situation whereby the hedging flow holds the market down for a period of time, but ultimately it's artificial. It is just hedging flow. It is no longer term flow. There's not going to be any continuation move. So again, you see the market come back up. That's a general pattern on an auction. Now, you do get a bit of other information with an auction. What you get is you get a bid to cover, press B to C. What the bid to cover ratio is, it's the amount of bonds bid for in relation to the amount that they're trying to sell. So the government is trying to sell 10 billion. If they get bids of 20 billion for the bonds, so that's the total of all of these bids along the line, no matter what value they're for. If they get bids for 20 billion, then you've got a bid to cover ratio of 2. Higher bid to cover ratio generally implies that there is good demand for the bonds. However, where this becomes tricky is when you bring in a tail. A tail is the distance from the average bid to cover, or sorry, the average bid. So say the average bid is here, 2.6. It's the distance to the most distant bid. So if the tail is very, very long, so if this was, say, 3.6, you would get a 1% tail. That implies that there's a lot of people asking for a much higher yield to take the bonds. Where you see an adverse effect for the bonds, implying that there is not a great deal of demand for the government bonds, is where you see a very low bid to cover and a high tail. So if you see these two, low bid to cover, high tail, what this is implying is that there's very few people willing to bid, but also those who are bidding are actually asking for a very high amount of bonds, hence why you've got this large tail. So that basically implies that demand for the bond is very limited. This has the knock-on effect of putting a flow into the market that demand is low for those bonds, and therefore those bonds get sold. That in turn increases the yield, and so the next auction, those people bidding further away up at this 3.6 area can get their fill. Ultimately, the key takeaway really is that the banks taking the bonds will be long, and so they will hedge into the auction, and then that flow is reversed at the end of the auction. That is the general pattern. The difficulty, of course, is gauging it on a price ladder, rather than there's not a specific time. You don't know when the auction's going to be priced. So ultimately, you've just got to watch the ladder, watch what happens, and see how the market comes out of the auction. So let's move on. Here's that common pattern that I've spoken about, and I'm using French auctions in this example. The reason I use a French auction is at the beginning of each month, I believe the first Thursday of every month, France auctions a large number of bonds. They do them across various different yields, so you get a lot of bonds getting auctioned all at once, so you get a lot of hedging flow coming into the market. This is why you see this big pickup in volume as the flow comes into the market. It is then reversed. You've seen it very, very nicely on these examples that you get the move down, particularly in November and December. The hedging flow is not so much to the downside in January, and you just got the move straight up. This could have been a variety of factors. This could be the possibility that people didn't get the fills that they expected on the auction, and so then they overhedged themselves and they had to rush higher. Also, what could have happened is you get the drop down that comes, and then the market turns around on the fact that the flow that has pushed the market down has to be reversed because it is artificial.
Okay, so this is the French auction. I'm playing this at a slightly faster speed because it is quite a long process that goes through. What we've seen so far is the oats have come off, so your oats are in the bottom right corner, bunds the ladder on the left. Oats have come off, it's dragged the bund lower. Remember, the bund doesn't necessarily need to be coming off, but it's dragged down by the movement in the oat. We're now seeing the bund getting bid back up. This is why our trader has entered, got long the bund. You can see that little pickup in volume around these 35 area, 4,000 lots done, and then you start to see this drift back up in the bunds. Meanwhile though, we go and have a look over towards the oats. You're seeing a lot of waiting around. What's going on is this hedging's continuing. You notice a huge amount of volumes going through at 01, 02, 00 area. This was, trading around 200 lots had been done. Over the past few minutes, we've very quickly seen this move up to 2,000-3,000. And this is where that hedging's getting done. The banks that are expecting to get their fills of oats are pre-hedging them, and that's how come you're seeing this continued selling. It's once you get that release, once you push through that selling, that's when you're going to drive higher. That's when you're going to see the oats start to move on back up the page, and this will continue to drag the bunds with it. So at the minute, you're seeing once again the oats push up to 6s straight the way back to 3s, and again that selling continues. Eventually you're going to be thinking to yourself, if you were trading the oats, once you start getting through 6s, 7s, this is when the speed picks up, and there we go, we're through 6, 7s now, up to 9s, struggling a little bit. What often happens is the hedging is then done a little bit later. You'll see that once a lot of hedging has been done, you'll then see selling as the market moves up. So it means that the move struggles a little bit to start with, and then it starts moving on. We're now into the teens in the oats. The bunds holding around those 45, 6s. There is a little level up at 50s, and so that's what's going to hold the bund a little bit further as well. But you see, there's nothing really selling. There's no real pull back in the bunds, and this is a chance again for our trader perhaps to get long a little bit more in a moment. Look for that kick on through 50s. Oats, again, they're holding up now. 14s, we're seeing a little bit of hedging around there. Seeing that volume pick up around 14s. It's struggling there, But as we continue through the auction, as we move closer to the pricing, that's when you're going to get that push up, and you're looking for that little flick, you know, that little burst of energy, and that's what gets you out. You see, our trader's built his position a little bit more now. We're approaching around about the time of pricing, and we still continue to see this just holding off in the bund again around that 50 area. We're waiting for that pop through 50s, and that's your opportunity to get out. Oats still holding high teens as well. Now they're starting to break, push up to 19s, up to 20s, but we keep holding down a little bit, and we are now just waiting for that little push higher. There you go, you see the oats into the 20s now. Now they start pushing up, and you get that flick higher in the buns up to 55 6s. The oats are now up into the mid 20s, 30 area. That's where you get out the trade. That is a bit of an ideal way of trading an auction.